RBI hikes repo rate to 5.40%. Why indecision? The repo rate, the rate at which RBI lends money to commercial banks, has been hiked by half a percentage point. Keeping in view the current unfavorable global environment, domestic economic activity, and comfortably high inflation level, etc. RBI has increased the policy repo rate by 50 basis points to 5.40%. The policy rate has been increased for the third time in a row in the fourth monetary policy review of the current financial year. Overall, the repo rate has been increased by 1.4% so far in 2022-23. Inflation rate in the month of June stood at 7.01%. For the sixth time in a row, the rate of inflation has exceeded the RBI's fixed limit of 6%. During the current financial year so far till August 3, there has been a large portfolio outflow of US dollar 13.3 billion. What are repo rates? The job of Reserve Bank is to decide on policy rates. The policy rate on which transactions take place between the Reserve Bank and other commercial banks. All other banks take loans from the Reserve Bank for a short period. The rate at which the loan is taken is called as repo rate. Repo means at what interest the Reserve Bank is giving money to other banks. Reserve repo rate. On the contrary, when the bank has to deposit its money to Reserve Bank, it gets interest. This rate of interest is called reserve repo rate. Reserve repo rate means that other banks are depositing their money in the Reserve Bank, so how much interest are they getting? How does repo rate work? The Reserve Bank of India uses the repo rate to control the flow of money in the market. When the market is in inflation mode, the RBI increases the repo rate. An increased repo rate means that the banks who take money from RBI will be made available that money at an increased rate of interest. In such a situation, due to increase in interest rate, banks will take less money from RBI and the flow of money in the market will remain under control. If banks take loan from RBI at a higher rate, then they will also issue loan to the common people at a higher rate. Due to this, the EMI of the common man will be expensive. In view of this, people will take less loan and spend less. This will reduce the demand in the market and will help in controlling inflation through the whole process.